Have you ever watched your investments soar to dizzying heights, only to see them plummet soon after, wiping out years of gains in a matter of days? That's the agonizing reality of economic bubbles, periods of market euphoria where assets seem to double, triple, or even multiply tenfold before the music abruptly stops and fortunes vanish overnight. From tulips in 17th century Holland to digital art tokens in the 21st century, bubbles share common patterns driven by human psychology, market hype, and the lure of extraordinary returns. Today, we're delving into the dark truth behind these bubbles, exploring why they form, how they've repeated through history, and what lessons can help us avoid the next calamity. Let's begin with a fundamental question. What exactly is an economic bubble? In simple terms, a bubble occurs when an asset, stocks, property, cryptocurrency, even tulip bulbs, becomes massively overvalued due to rampant speculation. The price no longer reflects the asset's inherent worth, like earnings, dividends, or practical utility. Instead, it climbs because investors believe someone else will pay even more tomorrow. The key driver here is the belief in perpetual upward momentum. People see prices rising and jump in, afraid of missing out on quick gains. As more buyers rush to join the party, prices surge further, reinforcing the illusion of limitless growth. That euphoria continues until a tipping point arrives, some traders decide to sell, panic cascades, and the bubble bursts. Those left holding overvalued assets face massive losses. We can break down most bubbles into 5 distinct stages: displacement, boom, euphoria, profit-taking, and panic crash. It often starts with a displacement, something new or exciting, a groundbreaking technology, a fresh industry, or a wave of cheap credit that floods the market. Next comes the boom, where asset prices spike as investors and media buzz feed off each other. The euphoria stage marks the peak of frenzy. Everyone from seasoned pros to your neighbor's dog walker is convinced this time it's different. Then smarter money gets nervous. The profit-taking stage sees early movers cash out, but most remain convinced prices will never fall. Finally, panic hits. Once a catalyst, maybe bad news or margin calls, shatters confidence. A rush to the exits brings prices crashing down. The earliest famous example is Tulip Mania in the Dutch Golden Age. In the early 1600s, tulips became a luxury item symbolizing wealth and status. Rare variants sold for astronomical sums, sometimes exceeding the price of a canal front house in Amsterdam. Families leveraged property and assets just to speculate on these bulbs. Prices climbed until buyers realized no flower, however pretty, could justify such expense. Virtually overnight, the market collapsed. Fortunes were lost, and the episode became a cautionary tale. When asset values become unhinged from reality, disaster often follows. Fast forward to the 1929 stock market crash, which led to the Great Depression. The Roaring Twenties were a decade of ballooning stock prices, fueled by cheap credit and unbridled optimism. Newspapers touted new economic eras, while ordinary citizens borrowed heavily to purchase stocks on margin. Yet the market's surge lacked solid underpinnings. Industrial output and wages were lagging, but speculation soared. By October 1929, cracks turned into a landslide, culminating in Black Tuesday. Stocks imploded, shedding billions in a matter of days. Banks went under as debt-ridden investors defaulted. Unemployment soared, ushering in a decade of hardship. The lesson: when investors use excessive leverage on inflated assets, any downturn can trigger a chain reaction. Another cautionary tale is the dot-com bubble of the late 1990s. With the internet spreading like wildfire, tech startups seemed poised to conquer every sector. Venture capitalists poured money into anything with a dot-com in its name, while newly public companies soared despite lacking profits or a viable business model. The Nasdaq shot up nearly 400% in a few years. Yet behind the scenes, many dot-coms burned cash at a frightening rate. By 2000, cracks formed. Investors realized not every online pet store or delivery service could thrive. Stocks crashed, wiping out $5 trillion in market value. It proved once again that hype, even around transformative tech, can blind people to basic fundamentals like revenue and profitability. Then came the 2008 housing crisis, a bubble so severe it nearly toppled the global financial system. Low interest rates, lax lending, and the widespread belief that home prices never go down sparked a mortgage mania. Borrowers with questionable credit took on loans they could barely afford, while Wall Street packaged these mortgages into complex securities sold as safe investments. House prices rocketed, fueling more speculation. When defaults rose, confidence in those securities crumbled. Major banks teetered on the brink of collapse, and the government had to intervene with massive bailouts. The resulting recession was the worst since the Great Depression. Here the bubble grew on the back of easy credit and a universal conviction that real estate was a risk-free path to wealth. Most recently, crypto and NFT mania from 2020 to 2021 repeated the same cycle. Bitcoin soared from around $10,000 to nearly $70,000, as newcomers believed the digital gold rush would never end. Meanwhile, NFTs, digital tokens representing art or collectibles, fetched millions of dollars, often for items with little tangible utility. Early adopters reaped huge gains, fueling envy and FOMO among others. But as market sentiment shifted in 2022, crypto values plunged by over 70%, and NFT prices collapsed. Billions in paper fortunes disappeared. Why, despite these recurring crashes, do we keep falling for bubbles? In short, human psychology never changes. FOMO, fear of missing out, is potent. Watching others get rich overnight triggers a desperate desire to join the party. We rationalize that this time is different, ignoring how often that phrase precedes a crash. Greed overpowers caution as everyone chases fast money. Media hype then amplifies the frenzy, with news outlets glorifying skyrocketing prices. By the time sober voices urge caution, euphoria is entrenched and few listen. When reality does intrude, panic selling ensues, often too late for a graceful exit. So how do you protect yourself from the next bubble, given that another one is probably brewing as we speak? First, focus on fundamentals. Ignore hype-driven memes or headlines touting guaranteed riches. Demand real earnings, tangible value, or robust business models before investing. Second, beware of excess leverage. Borrowing to buy assets can multiply profits, but also magnify losses if prices turn. Third, keep a skeptical eye on industries where valuations outpace actual results by massive margins. Fourth, watch for signs of euphoria, like people quitting jobs to day trade or casual conversations morphing into investment tip sessions. Historically, these signals often appear just before a major downturn. It's also crucial to accept that some innovations, like the internet or electric cars, may well be the future, but that doesn't justify any price at any time. Valuations must align with realistic projections of profitability and adoption. The fact that an industry might change the world doesn't mean every related stock or token will thrive. Bubbles form when emotion supplants rational analysis, turning even legitimate breakthroughs into fodder for wild speculation. In the end, a healthy dose of historical perspective can guard against ruin. If you see parallels to previous mania, like endless media coverage proclaiming a new paradigm, or novices piling in with no strategy, take a step back. Ask if the underlying asset truly warrants the price, or if fear of missing out has hijacked reason. Remember, legendary investors often dodge bubbles by exiting early, content to miss a bit of upside rather than risk a catastrophic decline. We might hope that regulation would shield us, but it rarely eliminates bubbles. While governments can limit leverage or improve transparency, they can't legislate away greed, overconfidence, and groupthink. Nor can they force individuals to heed the lessons of past collapses. Bubbles remain part of the financial landscape, tied to our innate desire for quick gains and our collective ability to suspend skepticism when fortunes appear attainable. Looking ahead, what might the next bubble be? Could it lie in artificial intelligence startups claiming to revolutionize every sector? or green energy ventures raising capital on futuristic promises? Perhaps real estate in certain emerging markets, or esoteric assets like rare metals or farmland? Each bubble claims unique circumstances, yet the underlying psychology never changes. Displacement, boom, euphoria, profit-taking, panic. It's the same script, just different players and industries. So as you navigate the market, remember the dark truth behind economic bubbles. They're fueled by our own biases, illusions, and unbridled enthusiasm for what might be rather than what is. We can't eliminate them entirely, but we can minimize the damage by recognizing the signs, tempering our greed with caution, and respecting history's repeated warnings. Human nature doesn't evolve as quickly as technology, so while the next mania might involve cutting-edge AI or mind-blowing digital assets, the storyline remains the same. Want more business and finance breakdowns like this? Subscribe to Biz Daily Digest for deep dives into business strategy, finance, and economics. Hit the like button if you found this interesting, and share your thoughts in the comments. Is there a bubble inflating right under our noses? Or do you think we've finally learned enough to avoid another Tulip Mania? The cycle of greed and fear suggests otherwise, but if knowledge is power, perhaps you can sidestep the herd when the frenzy begins and protect your wealth when everyone else is caught in the euphoria.